And today we're going to talk about the final valuation of McDonald's and your next homework assignment. Right? So the short answer is on Monday by 10 a.m. as an individual assignment for all sections, you're going to have to turn in 3 files. Right? One is the Excel file we completed on Monday with the as-is valuation of McDonald's. 2, you're going to do a final valuation of McDonald's, right, which is going to set up a target stock price and a buy, sell, hold opinion. And 3, you're going to do a minimum 500-word paper explaining your assumptions and analysis that went into creating the final valuation. Those are the 3 parts of the assignment. So today what we're going to do is we're going to talk about all the components that are going to be necessary to do that spreadsheet and to do that paper for the project. By the way, this is a miniature version of your group project. Okay, so whereas the group project will probably be something like 4,000 to 5,000 words, you're going to just do 500 words. But in a way, we're going to go through the exact process that you would do for your group project that you've already been assigned. Okay? So, with that in mind, what I want to talk about is there's 4 basically parts of the analysis that we're doing this semester, and that's what we're going to focus on today. Right? So the first is what's known as EIC. Right? We've already started talking about that, and you watched a video earlier in the semester about that. But EIC excuse me, stands for Economy, Industry, Company. And the idea of EIC, again, is about half the performance of any company we're going to evaluate is based on external factors. Good example, look at Exxon or Chevron today. Doesn't matter how good of an oil company you are, if the price of oil goes from $100 a barrel to $50 a barrel, there's nothing you can do. So the industry that you're in matters to the performance of the companies that we're evaluating. And so what's going to be important is how that industry is performing and what's going to happen to that industry over time. So let's first talk about the E for, in our case, McDonald's. So when I look up McDonald's in Bloomberg, the whole point of E, which is economy, is to look at how sensitive a company is to changes in the economy. Right? So is it economically sensitive, and does forecasting the economy matter? So is it a cyclical business, non-cyclical, etc.? So part of what we're going to be looking at to get a sense of that is a company's beta. So once you type in a company, and I'll go to McDonald's, again, MCD, US Equity, then you can type in BETA, and Bloomberg will calculate a beta for a company. Right? Now, by default, Bloomberg will give you a 2-year historical beta. For purposes of this class, I want you to look at a 5-year beta. So I'm going to change this to 2010. Right? Now, help me understand this. So what does beta tell you again? What's beta? Yeah.
It's just the stock sensitivity to the market movements, basically.
All right, so if McDonald's has a raw beta of 0.491, what does that really say?
That means for if the market moves 1%, McDonald's will move 0.491%.
Okay, so McDonald's is not going to go up as fast as the market, not going to go down as fast as the market. So, excuse me, that would be the point. Is what we want to understand is that McDonald's, based on historical 5 years, is not as sensitive to the economy as the average company. So for McDonald's, it's going to be less important to worry about changes in the economy than it would if we were talking about somebody else, right? And so that's really all we're trying to assess here with the E. Now, by the way, Bloomberg has 2 betas. It has the raw beta and it has the adjusted beta. When Bloomberg actually calculates cost of capital, it uses the adjusted beta. So basically the way the adjusted beta is calculated is you take 2/3 of the raw and 1/3 of 1 and you do a weighted average. So really the adjusted beta is just putting in what's called a coefficient, a regression coefficient, to move the raw beta 1/3 closer to the mean. So statisticians believe in regression to the mean. So they just move the beta closer to the mean. So if it's below 1, they move it closer to 1. If it's above 1, they move it closer to 1. Because they believe that there's going to be regression to the mean over the long run. So for purposes of this class, we're not going to get into sort of a philosophical debate about whether we like the raw beta, which is the actual slope of this line, versus the adjusted beta, which is the slope of the line moved 1/3 closer to 1. I'm just going to say for purposes of our E, which is sensitivity to the economy, we're going to use the raw. And here's the assumption that we're going to make. We're going to say that basically the economy and the stock market are tied together. So beta ties an individual stock to the stock market. Therefore, if A equals B and B equals C, A equals C, what's the proxy of sensitivity of the company to the economy? That's the way that we're kind of thinking about this. Now, caveat, the past doesn't predict the future. Right? That's the danger with a lot of what you learn on the academic side, is almost all of the academics are using the past to predict the future. And they're assuming that the past will replicate itself. Problem is, it doesn't always work out that way. All right? So, yes, historically, McDonald's has not been sensitive to the changes in the stock market and therefore changes in the economy. However, that could change in the future. And we're going to be aware of that. But if I think about the nature of McDonald's business, here's where I have to put in my own point of view, that basically I'll assume that number one, in good times, people are trading up from McDonald's, and in bad times, people are trading down to McDonald's. That kind of intuitively makes sense to me, and I think that's actually what's happening here, and that's probably why the beta is 0.49, and I don't think that's going to change too much in the future. So it does make sense to me that this will probably continue, that McDonald's is not part of the sensitivity of the market, but notice that I'm articulating an assumption. So two things become very important in finance. Number one, finance is storytelling. You'll notice throughout the entire semester, I'm constantly giving you stories. I'm constantly giving you anecdotes, and I'm constantly explaining my rationale for those stories. That is so important in finance to do. So the problem that we have is that the math, believe it or not, is actually not that hard. Like, I could take a bunch of liberal arts majors from the campus over there and bring them into this classroom and teach them how to create Excel models. And those liberal arts majors can come up with the same assumptions that you did to create an as-is valuation of a company. But they don't know why they're actually creating those assumptions. And that's the point. The real value of finance is not the models. The real value of finance is the assumptions that go into the model. So it's not that I think a company's going to grow 3%. Like, anybody could put in 3, 2.5, 2.8 and see what happens. It's why did you choose 3%? That's what's important. So that's the other thing. You have to establish a point of view, right? And what I mean by that is, if you think about Warren Buffett, one of the things that makes Warren Buffett really good is that he has a very clear point of view on what he thinks is going to happen with a company. And in some cases, what will happen is the market will have a different point of view. And when he has strong conviction about his point of view and the market diverges, that's when he will pounce. Right? So if he thinks a company has a certain value and the market's undervaluing them, that's when he'll consider buying the company. If he thinks the company's going to have a certain value and the market fully values it, there's no reason for him to buy that company. And the same thing, if he thinks the company has a value and the market's going to overvalue it, there's no reason for him to buy the company. He's only looking for a point where his point of view is different than the market. But he's got to have conviction, which means he has to articulate what those assumptions are to really understand what that point of view is. That is part of your next homework assignment. So that's the idea. I want you to tell me what the beta is for the company that you're analyzing. In this case, it's McDonald's. But I want you to tell me what that means. Like, why do you believe that McDonald's is not very economically sensitive? And do you think that that's going to stay the same over time? Right? So again, in finance, very important to understand what I'll call the art of valuation. Science is easy. The art is trying to come up with a reasonable point of view of the market. That is the final valuation that you're going to do. So again, for your assignment, you're going to come up with a target stock price by changing the growth rates, changing the margins of McDonald's. But I want to know why. Why are you changing the margins, and what's the rationale behind it? That's what's in the paper. And by the way, that's what you got to do for your group projects. So we're going to start with the EIC, and as I said, the first one's the E. Is McDonald's sensitive to the economy? Right now, the assumption is it doesn't look very likely. So the second part of the EIC is the I, and the I stands for industry. Okay? And again, this was referenced in the video earlier this semester, but the general idea is what's going to happen to the performance of the industry over time. Right? Now, in this case, I'm going to go to the RV section to do my industry, And I'll go to the custom screen. And to look at the industry, I'm going to use the default Bloomberg Peer Set for restaurants in the country of domicile, which is the U.S. I'm not going to look globally initially. But what I'm going to look at is two things. We created a custom field called Operating ROIC. So here's the Operating ROIC for McDonald's. And then there's a WACC, WACC, which gives us the concept of spread. So we're defining the industry as these companies, right? These kind of fast food, fast casual companies, right? And the average operating ROIC of these companies right now is around 31%. And the average cost of capital of these companies is around 7%. Do you think we can call this an attractive industry? Right? It's a very attractive industry. So that's the point. McDonald's is in a very attractive industry. So what's going to matter when we do our valuation is not whether the industry is attractive today. We need that as a baseline. But what we also need to know is what's going to happen to the industry attractiveness in 5 years. So is the industry going to get more attractive, stay about the same, or get less attractive? Right? Now, here's some kind of thought behind this. So back in the 90s, I was working with a chemical company called Dow Chemical. And it was really interesting because they had just gotten a new vice president of strategic planning. And one of his first tasks is he looked at previously submitted internal capital requests. So when you work for a big company and you want to spend money, you got to justify it. So you got to put together a capital request. And then it's like a bank. They either approve or reject your internal funding request. So what he did is they looked at the actual requests that were approved over a 5-year period of time. And they wanted to see how they actually did versus what was originally promised financially, to see if they were good at predicting what the financial performance was going to be. And these were the ones that were approved, not the ones that were rejected. And what they found is the average approved capital request missed its guesstimate for financial performance by 50%. That's a scary number, that you're going to be half of what you promised. And these were the ones that were approved. So obviously Dow felt that they could do better at their capital planning process, especially since the margin of error was so high. So they hired a consulting firm called Maricon to come in and help them understand why they were missing so much, because it was basically causing them some financial problems. And what Maricon discovered is the number one reason that they were missing is they were over-optimistic on their forecast for revenue, and specifically for their forecast for price. And so they looked at how they were actually doing it by interviewing the people. And what they found was that the way they would do price is they would take whatever price they were selling at today and they would just raise it with inflation. And they would take their cost, they'd build in some cost savings. So price would go up, cost would go down, margins would go up, rosy scenario. And unfortunately, that wasn't the reality of what happened. What ended up happening is, as their cost went down, their price went down, right? Because they were selling in a commodity business. And basically, what Maricon said is, of course, you're making some wrong pricing assumptions, because what you should be doing, and this is their approach, is what they call ROIC based pricing. So here's a different approach. Rather than predicting the price going up by inflation, predict your ROIC. Right? So take the ROIC today, tell me what your ROIC is going to be in 5 years, and based on that prediction, back into what that price should be. So if the ROIC today and the ROIC in 5 years doesn't change, then your price is probably going to be about the same. If your ROIC is the same and your cost goes down, then guess what? Your price is going to go down. If your ROIC is lower and the cost goes down, then the price is really going to go down. So what they did was they worked with the teams and they figured out this 5-year what they thought was going to happen to the market. They went back to their business cases. They then looked at the pricing as if they had done ROIC-based pricing, and they found that ROIC-based pricing would have made the business cases very close to what happened in the real world. So it really changed their whole thinking on the way they did the cases. And I got to see some of this process, and so again, it's kind of informed my view of the world ever since then. So that's what I'm going to ask you to do, is we're going to do industry analysis and ROIC analysis based on the industry analysis to help us understand the ROICs of these companies going forward. So again, back to Maricon. What Maricon said was, you don't directly forecast ROIC. right? Because it can be very important to figure out what's going to happen to the ROIC in the future. And I said, just directly forecasting ROIC is a bad idea. So here's what you do. You look at the Porter 5 forces, or some industry model. We're going to use Porter 5 forces to explain the industry ROIC today. Then you look at the change in the forces, and then the change in forces will then inform the change in the ROIC. So rather than directly forecasting ROIC, you forecast a change in the 5 forces. So what does that mean? Well, first of all, it means that I open up Excel and I create a spreadsheet which has, for both today and in 5 years, the 5 forces. And Porter's 5 forces are buyer power, supplier power, substitutes, entry and exit barriers, rivalry, which gives me an overall industry 5 forces assessment. Okay? So, back to this. We said today, and it's important that when we do the industry analysis, it's not McDonald's, the industry that we're doing. It's the industry McDonald's is in. So, based on the RV screen, McDonald's is in an industry today making 31% with a 7% cost of capital. That's a very attractive industry. Okay? So what we're going to do is we're going to score this just arbitrarily on a 5-point scale. And we're going to use language specific to this class that says a 3 means you earn your cost of capital. A 3 is a break-even industry. You just earn a cost of capital. A 4 or 5 is you do better than your cost of capital. And a 1 or 2 is you do worse than your cost of capital. So giving that methodology where, again, 5 equals well above, or to say very positive spread, 3 equals 0 spread, and 1 equals very negative spread, I would say that based on this data that we're seeing, it's a little bit smaller, that this is a 5. It's about as good as it gets for an industry, right? That fast food, fast casual is a really profitable industry right now. So the real question is, what's it going to look like in 5 years? Right? Do we think it's going to be just as good, a little bit worse, probably not going to get too much better? So what's going to happen? That's what we're going to try and do. So by doing that, we want to explain it using these 5 forces. Now to help us, because again, you're all consumers of this food, but you may not know too much about the industry dynamics, and you need to. So we can use real-world data sources. Again, that's the point of this class. This class is all about using the real world. And it's perfectly acceptable in this class to use real-world data sources. However, don't plagiarize. So if you use somebody else's data, just tell me you're using somebody else's data. That's acceptable. If you use somebody else's data, call it your own. That's not acceptable. So you got to reference, but don't plagiarize. So here's an example of what we can reference. So on Canvas, there's a link called VBIC. And in VBIC, there's a link to the industry data sources. And the first one on here is something called IBIS World. What IBIS is a subscription data service where they basically do industry research reports. Okay, so you can type the name of the industry or company. So in this case, I'll type in McDonald's. Do a search. And this will give me the industry reports that McDonald's is in. For U.S. reports, Canada, global, and China are the subscriptions that we do. Now, as McDonald's is a global company, we probably want to look at both the global and the U.S. reports, but you'll see they're in multiple reports. They're in donut stores, probably don't care too much about that one. Cereal production, that's probably not their primary industry. Coffee stores, probably not their industry. Street vendors, that's not McDonald's. Fast food restaurants, that's probably the report I want. And like I said, I can get the same one for global. Now, here's the idea. I downloaded this in the previous class by just clicking on the link, and it gives you a PDF, right? Or what you can do is you can go back here and you can just click on fast food restaurants, and it'll bring you to the web version. Now, here's the useful part of this. If you go to Industry Outlook, they've basically done a 5 forces analysis. Right? So again, particularly when you're looking at industries like healthcare, for example, or others that you may be less familiar with, then obviously using the industry report will help you because these are people that are kind of predicting what's going to happen in the future. But the other side I want to mention that is useful is if you come over here to key statistics, which will be at the end of the PDF, they also forecast industry growth rates. So for example, for McDonald's, 2015 revenue growth rate for the industry, 1.4%. 2016, 1.5%. 2017, 1.6%. 2018, 2.5%. 2019, 1.9%. 2020, 2.1%. So here's the idea. Eventually, we're going to have to forecast the growth of McDonald's. So part of it's going to understand what's the growth of the industry. And what we can see is 1 to 2% per year is what IBIS is predicting for U.S. fast food, fast casual restaurants for the next 5 years. So that would be the point, is that if I think about McDonald's growth prospects, I had kind of backed into around 1%. We did the as-is valuation on Monday. Now, I hadn't really looked at this research report, but it would have been better if I'd looked at this research report, but that would be the same idea. We get into a similar place, is that McDonald's is in an industry that's not really growing, and that's what we need to understand. So there's not a lot of growth in this industry. But right now, they're very profitable. So let's talk about what's going to happen here to explain that this is such a profitable industry. So why? Which of these forces, and the way I want you to think about the forces, we're going to score these on a 1 to 5 scale, except I don't want you to score it whether or not it's a strong or weak force. I want you to score it whether that force helps or hurts the industry ROIC spread. Okay? So, why is this industry so good? Which of these forces helps the industry be good? What do you think? And I know we didn't read through the IBIS report, but what do you think? Just kind of give me some thoughts. Yep.
There's a lot of options.
The buyers have a lot of power? Okay, so score buyer power for me on a 5-point scale. So if the buyers have a lot of power and it doesn't hurt the profitability, it'd be a lower number. Okay. Now, here's the other caveat. Remember that this industry actually makes 31%. So despite our biases, we eventually had to explain why this industry is making 31%. Right? So let me go back and re-ask the question about buyer power. We do have a lot of choice, but are we exercising that choice?
We have more than we used to.
Are we?
Yeah. McDonald's same store sales.
This isn't McDonald's. Remember, take yourself beyond McDonald's. These are for the fast food, fast casual industry in general. It's all the companies on that list.
So, no, not really.
So that's the point. We're probably not exercising as much power. So I'll just do the same survey I did in the last class. Just by show of hands, how many people eat fast food at least once a week? Once or more a week? Just by show of hands. All right. So hold your hands up for a second. How many people go to the same places on a regular basis versus are always constantly trying new places? Right? So the people that go to the same places, how many people go to 5 or more different fast food places in the course of a month? Right? One brave soul. So here's the point. I think that we are kind of slaves to brands. That in a way, yes, we'll go out. And somebody said, in the was it Stamp Food Hall or whatever? I don't go there, but Student Union. There's like a bunch of fast food places, but they go to the same ones. So yeah, maybe one day you go to McDonald's, another day you go to Taco Bell, and then you go to Chick-fil-A, and then you kind of go back through the list. Or maybe you just love Chick-fil-A and you go there all the time. But that's back to the point, is that we're not really, as much as we have choice, we don't appear to be exercising choice. And I think as Americans, we like brands. So we tend to go to the branded places rather than the unbranded. I'm not saying that some people don't go. Obviously, he's willing to try new stuff. But notice that most people here tend to go to the same place. So I go back to the buyer power, and I want to re-ask you the question. Do you think the buyer power is really hurting this industry? Go ahead.
I don't think so.
So what were you gonna say?
Yeah, that's what I was. Well, I was gonna say there's different factors. Like, I know I like cheap food, so
Understand, but I'm just saying we're trying to explain why these companies are making money. So let's go back to cheaper food. So I might call this a 4. Now let's be very clear on this. As part of your homework assignment, you're going to be doing your own scoring, and we don't have to agree because A, this is real world, and B, we're going to be predicting the future, and we don't know how the future is going to turn out. So even when the TAs grade you, we can't necessarily grade you on whether or not we like your answer because maybe we disagree with your answer. So that's why it's so important to articulate your rationale. You got to give me your assumption. Why do I think it's a 4? Why do I think it's a 2? You can't just say 4 and 2. That's just too easy to do. So I'm giving you my thoughts on this, which you may disagree with, and that's okay, but that's what we got to eventually come up to an understanding with. So let's talk about cheaper food. To me, that sounds like rivalry. So how much rivalry do you think there is amongst the fast food companies?
everyone's constantly trying to lower their price
Are they?
for more food. Yeah.
I'm just going to challenge the assumption. Are they really lowering their price?
Well, from what I've seen, the places I eat, yeah.
Okay. Go
Is
ahead.
this rivalry between firms in the industry or
Yeah.
between industries?
Between the firms in the industry. So McDonald's, Yum, which is Taco Bell, KFC, like I said, you got who else? Wendy's, Burger King, Chick-fil-A's, all those companies.
I think that all there's a high rivalry because like you see all these different fast food chains trying to like match what other fast food companies are doing. Like Taco Bell's introducing all this new like breakfast lines. Everybody's now serving coffee to like appeal to the masses. They're all trying to match each other. So I think rivalry's high.
But let's just go one step further on this. And I'm going to say, I agree with what you say. But here's the interesting point. Are they really competing on price, though? Because they're matching the types of foods, but they're not forcing each other to lower their price in order to get sales. Because I think, in a way, there's a little collusiveness in this industry. Because I'd rather compete by giving you a breakfast sandwich than by taking my existing taco and making it 59 cents versus 99 cents. So I'm not slashing the price. All right, I'm giving you more choice as a way of maintaining the price. So as I said, I don't think there's huge price wars amongst these companies. I think that there's actually less price wars and more option wars. But the idea is that I can get you to bundle stuff. Because when you go to Taco Bell, very rarely do I know people that go to Taco Bell and just buy one 99-cent taco. You're usually buying a whole slew of 99-cent tacos, and suddenly you spend $6 on the really bad food, right? But nonetheless, sorry, go ahead.
I was gonna say I think that they're not to build on the Taco Bell thing. Like they're trying to offer these new things because they're trying to bring in people that want like a breakfast, not necessarily to like outbid the pricing. Because like you had said, with the people who generally go to the same places over and over again. So if you add new options, you could hopefully steal somebody away from other places.
Matter of fact, McDonald's is now testing, as of yesterday, all-day breakfast. They're starting out in San Diego with this, and they're talking about going nationwide. So again, a way of, Taco Bell's going for breakfast, McDonald's is taking their breakfast all day.
So if we're talking about projections into the future, like with the growth of the economy, price might not be as important as brand or selection or something like that.
Which goes back to the beta.
Future.
That people are willing to trade up when they're wealthier to better quality or more choice. You gonna say something? You're just picking, okay. All right, so back to this. So here's the thing. If I said, let's just go with this is a pretty tough rivalry business, and I do this is a problem because this industry is making 31%. So remember, at the end of the day, we got to explain why this industry is making 31% when we do this. So that's what I said. It's not that I don't agree with you on rivalry, but I go back to the rivalry and I say, even with this intense rivalry, which is also the most important force, is rivalry, this industry is still making 31%. So is the rivalry really as intense as we might think it is? Otherwise, they'd be making less than 31%. So that's what I said. Maybe there's some rivalry, but I might call this a 3 or a 4. I think it's very cooperative, friendly rivalry. Like it's boxing with gloves, right? And with rules. And I think that there's a little bit more collusion. But again, you might disagree because this is what you're going to be writing up in your 500-word paper, right? Because you're going to have to come up with your own assumptions for this. Yes?
So is your goal here that like the average of these should come out to the overall? Well, then everything should basically be.
Or, here's the thing. You can say one force trumps the others. So I'll score something low, but it's just irrelevant. Like, for example, maybe your suppliers have a lot of power, but it doesn't really affect the industry because the cost of food is so low compared to the margins. Or maybe the supplier power is high, but they're not really exercising it either. So it doesn't have to be every 4 set to average out, but you got to at least explain with a weighted average how you get closer to 5. Because as I said, at the end of the day, we're 31% return industry. That's what we got to try and explain. Yeah.
I was gonna say if your rivalry is at a 4, I think rivalry and substitutes go hand in hand in this case because, like what you said, like there's a McDonald's, then like a substitute for McDonald's could be a Taco Bell, a substitute for that could be something else. And if you're judging it just based on not the competitiveness, but how it contributes to 31%, I think substitute should be like a 4.
Okay. Now let's talk about entry barriers. I'm going to call that a 5. Right? Now the reason I call that a 5 is how many truly national fast food chains are there? And how easy is it to open 4,000 restaurants? And how much capital is required? And how much branding is required to do that? And so, as I said, yes, there are other choices. But some are small, some are regional. And if we think about the national brands, there's very few of the national brands out there. Now, as a matter of fact, I think the best burger place in the country, which you can't even get in Maryland, is an example of this. Anybody know what I'm talking about? In-N-Out Burger. What, you don't like In-N-Out? Oh, you love In-N-Out? Yeah. Again, everybody's like, who's In-N-Out? If you ever get in the West Coast, try In-N-Out Burger. There's lines around the block. But long story short, they're not even a national brand. They're like in 7 or 8 states. And that's the thing. It's really hard for them to expand to national because it's not just open up the stores. It's getting all the distribution and getting all the franchisers and all that other stuff. It's a lot of investment up front. Yep.
And I was gonna say that Chipotle came out of nowhere, but they were founded in 93. So
And Chipotle was supported by McDonald's, who had very deep pockets. So again, I'm not saying that you can't get in, but it's very hard, and I think that protects the incumbents. Right? Matter of fact, the other thing is suppliers. I don't think, since most of this is commodity food, that basically that the suppliers are exhibiting a lot of power because beef is beef.
What do you think?
Right? However, insightful, and this is what matters. The absolute numbers here are important, but they're not as important as what follows. How are these going to change? The delta of the changes is what matters more. So, is supplier power going to stay the same? Is rivalry going to stay the same? Because if that changes, that's what's going to influence our future view on the industry and therefore McDonald's. So let's talk about suppliers. Somebody in the last class actually had a very interesting insight about supplier power getting stronger and hurting the fast food industry. How might that happen? Yep.
Isn't there a push for like healthier foods?
There's a push for healthier foods. So what are some of the industry companies saying? Does anybody here shop at Whole Foods, also known as Whole Paycheck? What is Whole Foods all about? You go into their meat department or fish. It's organic and sustainable, which means, does everybody sell organic food? The suppliers, do they grow organic beef? No, they inject it with antibiotics. So they're saying we're going to do antibiotic-free stuff. Does everybody do sustainability? No. So what does it mean? It means Whole Foods has fewer suppliers to choose from that meet that criteria. So in a way, the industry, by going down this path, is actually putting more power in the hands of the suppliers because I can't just go on the open market and buy a chicken anymore. If I want antibiotic-free chicken, then I actually have to go to fewer suppliers that do that. In a way, I've given those fewer suppliers more power, which is going to probably raise my cost, which is why Whole Foods is so ridiculously expensive, because they're not just going on the open market, they're going to fewer suppliers, which are smaller, which are essentially raising their price. So their whole point was this industry is going to start facing higher food costs as they start dealing with sustainability and organic stuff, because that's what consumers want, and that's going to change that supply balance. Now, it's not going to tip it completely, but in 5 years, you could see it hurting the industry ROIC a little bit. They're not going to get the same margins on their food. Their food cost goes up. Yeah,
Isn't that what happened to Chipotle? Was like that pork?
absolutely.
Because they were looking for sustainable.
Yeah. And one reason why I don't like Taco Bell, because I really worry about the food quality there. And particularly when you get to be my age. Like when you're in your 40s, you actually have to start caring about food quality, right? Because you got to worry about your health, much more so than when you're in your 20s. But that's the point. That's why I increasingly shop at Whole Foods. It's not that I really like Whole Foods, but I just know that processed stuff is really bad for me. So if I go to a place where I can't get processed stuff, it makes it easier to shop. Matter of fact, that's the other thing. Substitutes. I think that substitutes are going to start to change because guess what I can get at Whole Foods? Besides food, obviously food, but I can get a fast meal. Increasingly, grocery stores are now looking at themselves as, hey, come to our grocery store, we'll give you a freshly prepared meal, take it at home. Believe it or not, I think another substitute is people actually cooking at home, right? As kind of crazy as that sounds, I think people are actually eating more of their own cooked food rather than going out to fast food. So maybe we're not seeing the trend anymore. So I think the substitutes might get a little tougher in 5 years. So maybe I'll call that a 3.5, and maybe I'll call that, which is basically going to put more power in the buyers. So again, at least a 4. I think the suppliers are a 4. I think it's still going to be hard to get in this industry, but maybe the rivalry is going to be a little intense. And what I say is the overall is going to be a little bit worse. Right? So what I've really done is I've come up with a justification for why I think that the industry is going to have lower ROIC in 5 years. Now, here's the point. This is what you got to do. Right? So I'm going through this relatively rapidly because you have to do this analysis and write this up with your own rationale. Now, you can agree with some of the things we've said here or disagree, and that's okay, but this is going to inform the spreadsheet for McDonald's and the assumptions that you make. Because when you make margin assumptions and growth assumptions, and to some degree risk assumptions, it's going to somewhat be based on what you think is going to happen to this industry. So this is the I in the EIC, right? Then you're going to do a C. C is what we define as competitive advantage, right? The key to competitive advantage is this. If you're really better than your peers, you should have a higher ROIC than the average. Otherwise, you're not really exhibiting competitive advantage. So McDonald's at 19% is good, but they're in an industry making 31. So they're obviously not doing as well as the industry you're in. Because there's 2 parts to your ROIC. I'm getting a good return because I'm in a good industry, or I'm getting a good return because I'm really good at what I do. Now, McDonald's is getting a good return, I don't think today because they're really good at what they do. I think they're getting a good return because they're in a good industry. Right? And that's what the data kind of shows you. And that's the way I want you to start approaching this and thinking about this. Is a rising tide is going to rise all boats. A falling tide is going to shrink all boats. So that's the point. Is the industry going to get better or worse? And then what's McDonald's position relative to the industry going to be? So let's just say that based on my industry, I think instead of 31%, I think this industry is still going to do well, but maybe mid-20s. Okay? That's just my initial gut point of view. Right? So I'm going to expect the ROIC to fall. Here's the question. What happens to McDonald's, which is making 18, given that? Does McDonald's still make about 18? So even though the industry falls, they do better, relatively? Does McDonald's then fall because the industry is falling? Or does McDonald's really change their perception, and therefore they actually rise while the industry is falling, and we start flocking to McDonald's? What's your thought on that? Because that's the C. That's the competitive advantage. Yeah.
So I think that's where the same store sales are kind of come into play. And they're definitely too entrenched in their A, business model, and B, like people's view on the company to be able to switch it and start.
So if you had to predict 5 years, give me a prediction based on what you think is going to happen to their ROIC.
Will drop with the,
So you think it'll actually come down because they're just too entrenched, and therefore the industry going down will hurt them.
I mean, maybe not a lot, but it's a little bit. Yeah.
Okay? Yep.
Wouldn't the beta come into play?
The beta could come into play.
Since so it's gonna drop, but not as much as like the industry would drop.
Okay. So you could argue that McDonald's might drop, but not as much, but you're still not expecting them to rise. So again, that goes back to when I do my model and I come up with my target share price, I should be looking at what I'm forecasting for an ROIC in 5 years. And if I see a big jump in the ROIC, then that's kind of inconsistent with what I'm saying here is happening at the industry level. So I'm saying this should inform some of the assumptions that we make when we create our target stock price in our Excel file. Yeah.
When you're looking to see if it's above average to see if they have competitive advantage, do you just look at ROIC or do you look at the spread?
I look at the spread, but since the cost of capitals are so similar, it's really the ROIC that is the differentiating factor. But the short answer to this question is it ROIC or is it spread? It's actually it's the spread. But in most industries where the cost of capital is the same, the ROIC is the differentiator. And here, the ROICs are so high that it truly is the differentiator. In fact, the only company that seems to really be struggling with ROIC is Wendy's. They seem to be the problem child of this industry. So, That's EIC, and that's part of what you're going to have to do. So to do EIC, what do you have to do? You got to look at the beta, specifically a 5-year beta, and we're using the raw beta in this class to inform sensitivity of the economy. You got to do an industry analysis, and what you're really doing is you're baselining where you think the industry is today, and more importantly, whether you think the industry is going to get better, worse, stay about the same, the conditions for earning the return. And then you have to do the company. What's the relative the position of the company versus the industry, and how's that going to change over the next 5 years? EIC. Questions? Yep.
Are there any specific metrics that we should be looking at when doing a company analysis rather than just saying, oh, this is what we speculate?
Well, as I said, the metrics I want you to start with for this assignment are operating ROIC and weighted average cost of capital. Okay. Now, obviously, we can layer this more complex over the next few weeks, but just because you're going to do a lot between now and Monday, just focus on this. A good question. Other questions? Yes?
The homework assignment is on McDonald's.
The homework assignment's at McDonald's. We're talking about some stuff here. And if you believe what I say, you're welcome to use some of this in your write-up and your assumptions. But if you disagree, and some of you do, and that's okay, then just articulate your assumptions. Because what I really am trying to get you to do here is I'm trying to get you to practice to basically start to understand that you got to articulate assumptions and come up with assumptions to make the math, as opposed to just going in 5 minutes, plug and play a few numbers to get a solution. Right? That's not what's going to make you a good finance analyst long term. You got to really think through why you're making the assumption. It's the art of finance, not the science. Science is easy. Right? So let's talk about the second part, historical financial analysis. Now, here's the key. The past doesn't always predict the future. We use the past to give us a map to the future, right? But that map is uncertain. So that's the point. We're going to look to the past not to necessarily guarantee the future, but to help us inform the future. And this is where I think a lot of the academics have trouble, because what you've been taught in previous classes, think about asset allocation. How do I do asset allocation? I look at the historical performance, I look at the historical volatility, and guess what? That tells me the way I should allocate. But that's based on the past, and that's assuming that the past repeats itself. And that's the problem, is the past always doesn't repeat itself. What happens if the company's risk starts to change because of the nature of their business? They get into far riskier businesses. Well, that's going to change the allocation. Or let's assume that the company's performance starts to change because they get into new business lines. And the risk of those new business lines is far different than the risk of the previous business lines. So again, we don't have that future, but we have the past to give us a basic understanding. But we got to be careful to understand that the past doesn't guarantee a future. Right? We just help us think through what the future could be. Matter of fact, that's why what you really should be doing is thinking about ranges. So it's not one number that matters, it's what's the range of outcomes that matter. Right? As a matter of fact, there's two ways to do that. One is you could just do it with the cost of capital. You can say, I'll raise the cost of capital because there's more uncertainty. But increasingly what people are saying is that's not a good way to do it. A better way to do it is not to change the cost of capital, but to change your assumption for cash flows. So give me a range of cash flows rather than a higher cost of capital. And that's a better way to think about risk, right? And so to think about the assumptions about the range. And that's the idea. If I have no idea what it's going to be, say I have no idea what it's going to be, right? As opposed to give me a number and you tell me with certainty, but you have no idea that that's what the number is going to be. Because that's what's going to make your model more robust and a better representation of the future. So back to historical analysis. 2 parts to this. For any company under the FA section, there's a sub-tab called Segments. And you can also look at by measure, by geography, by segment. Click on by segment. What's nice is we can see if a company has multiple segments, we can actually see how those segments have been talking about performing over time. Now with McDonald's, they pretty much have one segment, which is their stores selling food. But this is where same-store sales are for this industry. And you can see in the last 2 years, same-store sales have been coming down, 0.2%, negative 1%. Okay? But let me give you another example of this. So somebody had asked about this in a previous class, but here's Boeing. So I'm doing Boeing. So I come in here, click on FA, I go to Segments, and I go to By Segment. And what I quickly see is that Boeing is actually 2 businesses. Boeing is a commercial aircraft business, and Boeing is a defense business. Well, when I forecast Boeing, it's a little naive to just forecast Boeing because I have two businesses with different levels of risk, two businesses with different levels of growth, and two businesses with different levels of margin. So what the sophisticated analysts do is they actually say, I got to project the commercial aircraft business, I got to project the defense business, and then I add the two together, and that's Boeing. So they would take a spreadsheet like we have, and they'd either have two sub-tabs or a much more detailed tab where they're projecting the revenue or margins of each of the businesses rather than just the company as a whole. And here's why that matters. In 2009, Boeing's revenue for commercial aircraft was $34 billion, and for defense was about $34 billion. But over the last 5 years, Boeing's gone from $34 billion to $60 billion of commercial aircraft and $34 billion to $31 billion of defense. So there's a perfect example. Boeing right now is all about the growth and success of their commercial aircraft business. Boeing right now is struggling with the defense cuts and the sequestration that the government is doing as it's cutting back on their defense spending. So as I think about the business going forward, what happens to commercial aircraft? What happens to defense spending? That's how I'd have to forecast Boeing. It's a more important, granular way of thinking about the business. Same thing. What are the margins? The margins are going to be different on these businesses, right? So looking at the margin of the commercial business and looking at the margin of the defense business could also change. So the mix could change. Matter of fact, here's back to McDonald's. Here's what does matter. I go back to McDonald's. Go to geography. I didn't know this until this morning when I looked it up on Bloomberg. But McDonald's actually gets more sales in Europe than they do in the US in 2014. Europe is now bigger than the US. That surprised me, right? So that's the other part. Why might that be important if I'm analyzing McDonald's? That Europe is their biggest market. Yeah.
As of now, or rather currently, the European market is really struggling.
That's right. The European economy is really struggling, and the exchange rate is going way against McDonald's in Europe. So those are two factors which are hurting them. Now, my guess is that's already been picked up by the next 2 years of earnings estimates. But longer term, if I still think Europe is going to struggle for the next few years, then I got to think about that when I think about their growth prospects and their margin prospects. So this is what I mean by sort of granularity of understanding the business segments. Now, here's the next piece. 5-year historical analysis. In our model, I'll pull up the model we did for the as-is. This is where we left off on Monday. 2 parts to the as-is valuation. One, there's a tab in our model called ROIC drivers. This is the ROIC tree. And what the ROIC tree does is it helps us understand what happened historically to the company's ROIC. So 3 things, always 3 things, matter to the operating ROIC. First, their operating ROIC went from 22 to 18.9. So obviously it's a little worse. Factor 1, tax rate. Their tax rate went from 29 to 35.5. So they're paying more in taxes, which is obviously going to hurt their ROIC. So one of the reasons McDonald's ROIC is going down is because they're paying more in taxes. Right? So that's important to understand. 2, if I take out the impact of taxes, I look at the business itself. The pre-tax ROIC is also going down, 31% to 29.2%. So it's not just higher taxes that are hurting them. The performance of their stores is also getting a little bit worse. Now why? Reasons 2 and 3. Is it the margin of the stores? This is the operating margin, EBIT divided by sales. Or is it their productivity, also known as cycle time? Right? Well, I can see that the operating margin went from 31% to 29%. So for McDonald's, it's actually the margin is dropping. It's hurting their ROIC. Productivity, 1.005 to 0.991. Is that helping or hurting? Is that good or bad trend? Try to get rid of this helpful Dropbox link. Go away. There we go. Is 1.005 or 0.991 better? So what it says is To generate $1 of sales in 2010, they had to invest $1.05, $1.05, or 0.5 cents. And the same dollar in 2014, they had to invest 99 cents. What's better? So they're getting more productive. So higher productivity should help their ROIC. So really, the challenge of McDonald's is the lower operating margins. Okay, so for McDonald's, it's lower margins and lower tax rates. But as I think about my valuation and I think about what my margins are going to be going forward, obviously pressure on margins is something they've seen over the last 5 years. Now, if I drill down one level deeper, if I think about margins, 3 things affect margin. Gross margin minus SG&A minus depreciation. Right? Depreciation rates haven't changed all that much, so it's really gross margin and SG&A. Now, a little complicated, but Bloomberg, apparently between 2011 and 2012, it looks like they recalculated how they did cost of goods sold and how they did SG&A. That whoever was putting the data in for McDonald's started to change the way they put it in. Right? Because you can see a dramatic increase in gross margin and a dramatic increase in SG&A, but not much of a change in the overall operating margin. So it was just a reclassification by Bloomberg, which doesn't happen often, but obviously they did. So what's going to matter here is probably the more recent 3 years. So what do I see in 2012 to 2014? Gross margin actually stayed about the same, 61.7 to 61.4, 61.6. So the margins on their food is about the same. It's the SG&A, 25 to 26.5. They've been spending more money to get people to come into their stores, probably assuming that that would lead to growth. And unfortunately, they're not growing, right? So that's the problem, is they're spending money to get people to come to McDonald's, but you're not coming to McDonald's more frequently. So they're still making the same margins on the food. So still make the same, gross margin of 61% selling a Big Mac. But I'm spending a lot of money to get you to come in and buy those Big Macs. You're not coming in to buy those Big Macs. So that's been their historical challenge the last couple of years with the lack of same-store sales growth, is the money they're spending in advertising and other SG&As is not leading to more customer sales. Right? So, as I said, that doesn't tell me exactly what's going to happen in the future, but that's good context as I start to think about what I'm going to do with the margins and what I'm going to do with the growth rates in the future. Right? Now, the final step for the historical is to go to the CFI. CFI is our historical cash flows, and there's a lot of information to be gleaned out of the historical cash flows. So here's how we do the CFI analysis in this class. We take the historical years, which end in 2014, and then we take the future years, 2015 through 2020, and we hide them. We don't delete them, we hide them. So you select the columns, right-click, hide. Right? So all I'm going to see on the screen is the 5 historical years. Right? Then what I'm going to do is I'm going to say total. And with the total, I'm just going to use the sum function in Excel. And I want to make sure I don't sum the hidden years. I just want to sum the historical 5 years. This is what gets me sort of what's been going on for the last 5 years. So I just copy down the sums to all these other numbers. Right? So, by the way, what's reinvestment rate? Gross investment divided by gross cash flow. So if I think about it, before acquisitions, McDonald's is putting about 32% reinvestment back into the business. Okay? And they're generating $35.5 billion of free cash or gross cash flow, spending about $11 billion back in the business, not doing much in the way of acquisitions. So about $24 billion of free cash flow. Not much difference in the operating cash flow, but more specifically paid out a lot of dividends and paid out a lot of shares. Matter of fact, that was 27, almost 28 billion, which means to get the 28 billion, they actually had to go borrow $4 billion worth of new debt. But the point is, McDonald's is now making a huge investment in growth. And what's interesting is notice the CapEx, which was pretty high going into 2012, started to go down in 2013, and particularly was cut back dramatically in 2014. So what I can see is, and this makes sense, if I'm not getting same-store sales increasing, why am I opening up more sales? Why am I spending a lot more money on my stores? Especially if I don't see a lot of growth in the industry. So in a way, you can start to see that McDonald's is slowing down in their cash flow. Now, investments. Now here's the interesting thing. Over time, most companies tend to at least put in depreciation. Because if you don't put in your depreciation, the idea is that the wheels on the bus start to come off. So you got to fund your existing restaurants at least some rate. So depreciation is often used as a barometer to say I fund depreciation to maintain my business. They're probably not going to spend this level of capital going forward, but at least from a signaling effect, what I'm seeing from McDonald's is they don't look like they're spending heavily to try and grow the business. Right? So I'm probably not going to spend a lot more on capital going forward. So again, it just kind of helps me inform my forecast that I'm going to do financially. Right? So this is the historical analysis, which will help me when I do my forecast. Third section, multiples. Right? We've already done multiples on, was it Nestle, Unilever, Procter & Gamble, and whoever the fourth company was. So I want to look at the multiples. So again, I go to Bloomberg. I type in RV. I go to the template that we had previously saved. Here was the multiple template we created in our class. So I want to do the same multiple analysis on McDonald's that I did. I don't have to do it on every competitor, but just McDonald's, that I did on Nestle, Procter & Gamble, Unilever, and whoever the fourth company was. Now, here's the reason why. There's two things that are going to come out of this multiples more than anything else. Number one, it's going to give me a G. So I want to know what the market's estimating for the long-term G of McDonald's, so that when I get to my spreadsheet and I think about this growth rate in the assumptions tab, I just put in 2% arbitrarily on Monday. But in a way, from the multiples, I can kind of back out what G the market is actually using. So that's the point. I use the market to help me get a proxy for the G. Matter of fact, the other thing that I can get from the multiples is I can get an estimated EBIT margin. Okay? So how do I get estimated EBIT margin? Which two multiples do I look at for that? Yeah.
EV to EBIT, EV to sales.
That's right. So what I do is I take, I'll do it right here. So estimated EBIT is going to be my, and I'll put this in the spreadsheet if you want to even have it as a cell, is going to be my EV to sales and my EV to EBIT. In fact, I'll put the estimated below that. And I'm doing it for 2016, second forward year. So EV to sales is, right now, 4.12. EV to EBIT, 13.34. So my estimated EBIT margin is that divided by that. 4.12, not 41.2. It's around 31%. So what I'm telling you is based on the trading multiples today, the estimated EBIT margin for McDonald's is around 31%. As I said, I can also solve for a G using the formula that we had done earlier to kind of guesstimate what the G is based on the market prices. So that's what I'm saying. Why I use that? Because the G helps me get this, and the EBIT margin is really telling me what the market thinks this number is going to be longer term. Now it's interesting that the consensus estimate for 2016 is 30.9% EBIT margin. And that, based on the trading multiples today, is the way that McDonald's is trading long term, as that the average EBIT margin is around 31%. So here's what's interesting. When I did my as is on Monday, what I did was I had actually lowered the EBIT margin to get to the share price. But if I actually look at what the market is saying, is that they're not really doing that. I should have, for the as is, done this, and it would have told me is this number needs to be closer to 31, which means this has to be 37, because I can't directly change that starting in year 3, because we use the consensus for the first 2 years. Well, that gets me to a share price of 105. Now here's what's interesting. In order to get down to 90, this has to be like negative 2%, negative 3%, negative 3.5%. So if I actually look at what the market's predicting for McDonald's today, based on the trading multiples, it's actually declining sales and maintaining the margins. All right, so the market's much more pessimistic. So I go back to my assumption about competitive advantage. If McDonald's is declining sales in a market that's growing 2% a year, they don't see a lot of competitive advantage in McDonald's. And that's where I think there's a fear factor in the marketplace that the data shows me that is basically saying they fear for consumers continuing to shop there at the same rate because of the perception that they have of not being healthy food. So that's McDonald's problem. Now, whether I agree with that is a different story. Because when I do my target stock price, now I say, you know what? I think the market's got it wrong. I think McDonald's is going to find a way to grow. Now, they may not even grow it at, as an example, they may not grow at 2%, which is what the IBIS world says the industry is growing. Maybe they'll grow around 1%, which is where we were. And if they maintain their margins at 1%, they're worth $105. I should own McDonald's stock. This is a buying opportunity. Buy. You know? Or I think they are going to fall 3%. Well, sell. Or I think that they're going to fall 3% and I think their margins are going to come down. Get out. I'm heading towards that sell range. So I'm more in the get out of McDonald's. Don't own McDonald's. Put your money someplace else. Right? So as I said, there's not necessarily a right answer because I'll tell you today, if you look at the analysts covering McDonald's, A&R, 7 say buy, 21 say hold, 3 say sell. There's not 100% consensus amongst the analysts, but if you look at most of the analysts, they're in their fairly price range. Now, that's what I said. You got to come up with your own target. So you put in your assumptions around G, around growth, around EBITDA margin, and if you're within 10% of the current stock price, so basically in an $80 to $100 range, you're a hold. If you're above 10%, so in this case above $100, you're a buy, and if you're below 80, you're a sell. Okay, that's the way that you're actually doing your buy-sell holds based on your target price. And as I said, what you have to do is you have to come back and you have to articulate your rationale in those 4 sections. Now, I'm only asking for 500 words. I know we covered a lot today, so you have to do too much, right? But I still want to hear your assumptions for EIC. You can be straight to the point. You can say, hey, for the E, I think McDonald's isn't too tied to the company because their beta is this. Hey, for the I, and that's probably where we're going to write most of your write-up, is in the industry. Hey, I think the industry is going to get better or worse for these reasons. And competitive advantage, I think McDonald's is probably going to get better or worse. And then in the multiples, what you're really trying to pull out is the estimated G, and you're trying to pull out the estimated EBIT margin, which I just did for you. And for the historical analysis, you're trying to get a sense of, hey, McDonald's ROIC has been deteriorating because of a little bit higher taxes and a little bit lower gross margins. And so therefore, when I did my growth rate, I used this growth rate. When I did my EBITDA, I used this EBITDA based on previously what I had said and why. That's the 500 words or more that I'm looking for. And then 3 files that you're turning in. File number 1 was the as-is from Monday. We're not going to revise it. We're just going to turn in what we did. File number 2 is the manipulated as-is with the new assumptions. It's going to be called the final. File number 3 is a Word doc of a minimum 500 words. Don't write 2,000 words. Right? Too much for this assignment, 3 days. Write 500 words, but minimum 500 words because there's a lot to talk about. And then explain how you got to that final valuation, covering these 4 steps. That, by the way, is the group project. As I said, the group project is just more detailed. Questions? Yes?
So you want us to go about our growth kind of the same way that we did for the Nestle project? Or?
I want you to, for the G, I want you to start with a G that comes from the multiples exactly like you did in the Nestle project and the P&G one. However, what you choose to put in the model could be slightly different. Right? Because you're going to pull from the multiples essentially what the market's actually using to justify the price. But you may not agree with that. And that's the point of all of this, that you're going to pull from the market data numbers. And your goal is not just to plug in what the market says, because that's going to get you to the current price. And maybe if you believe that the market's 100% right and you agree with it, then you're a hold and that's okay. But that's what I want you to do. That's where you put in your assumptions. And the assumption shouldn't be, I think McDonald's going to grow at 3 just because. Like, there's got to be a rationale. That's why you're doing all this other legwork to help you develop the reasons for your assumptions. It's a process assignment. That's really what this is. It's to start practicing the process of integrating the information into a few assumptions, rather than just make it a math process where you're just manipulating some numbers to get to an outcome. Because that's what you're taught in most classes. Most classes just give you a model and you just manipulate it till you get an answer. Here, what I want you to do is not just do that. I want you to think about why you're putting the number that you are and articulate that to somebody with some level of conviction based on data. Data and your interpretation. That's what we're going to grade you on. So as we said, it's not whether I agree with your number. It's got to be based on fact. If you just completely make stuff up, it's a different story. But fact-based analysis that you're putting into this, that's the process. Other questions? I'm sorry.
The as-is file.
Well, the as-is file is what we did on Monday. That's this file that's on the screen right now without any changes. The manipulated as-is is what we're going to call the final. That means I come in here, I change my revenue growth, I change my EBITDA, I could change my tax rate if I think I need to, and I change my G. And that's going to get me a new stock price. So this is what we're going to call the final, or the manipulated as-is. That's the second file that you turn in once you do that. And then third document is the Word document with all of that analysis and assumptions summarized in 500 words, so it's about a page and a half, that basically explains how you got to that number. On Monday, for practice, when we debrief this, I'm going to randomly call people, bring you to the front of the room, and let you explain to the class your final valuations. So you'll make mini presentations on Monday about what you did, and then I'll give you feedback. Now that won't be for a grade, it'll be just for fun, right? But nonetheless, it's kind of a mini practice for what you're going to be doing in 1 month for your group project. So it'll be good practice. Yeah.
So the final spreadsheet will be identical to the as-is, except you change the numbers.
Correct. And then the third part is just give me the rationale for why you changed those numbers. That's the 3. And again, I'll post all of this in Elms and Canvas. I just haven't posted it yet because I don't want the people to work on it in the future classes before they show up. Monday, 10 a.m., turn in those 3 files. Monday, we'll talk about this in class. So this is where we get to the fun part of the semester. So hopefully everybody considers this to be the fun. This is the fun. So we're going to bring more fun. So next week we'll be doing the same thing, just new companies. Questions? All right. See everybody on Monday. And I just recorded this, so I'll post this on YouTube.